Public debt is the debt that governments owe. So it is distinct from private debt, like mortgage debt, or debt you might incur to go to university or to make ends meet. This means that public debt concerns state financing. The modern state has three main ways to finance itself. It can get money from its citizen, that's taxation. It can earn money, whether rightful or not, for instance via natural resources like oil. Or it can borrow money from investors. Across time and place, the public finances of most modern states featured a combination of these three ways of financing. The focus here in this video is on state borrowing, that is public debt. These days, most states are in the red, some more so, some less. Most of the debt of rich countries is financed with government bonds. These financial instruments come with different contracts and structures, but they all work in a similar way. To borrow money, the government issues a debt obligation that includes the commitment, the promise to pay periodic interest, called coupon payments, and the commitment to repay the face value on the maturity date, so say in 1 year, in 5 years, or in 10 years' time, to the holder of the bond. In the wake of the COVID-19 crisis, government funding needs surged dramatically, with OECD governments now borrowing trillions. Servicing this debt is costly, as you can see from this graph, and managing it is complicated. This throws up the question of how the state borrows money. Enter public debt management. Historically, the management of public debt changed hands numerous times, with a typical succession running from the private offices of rulers to elected or appointed assemblies, to ministers of finance or central banks, and finally, that's us now, to semi-autonomous debt management agencies. By the turn of the centuries, many countries have changed the way they manage their debt, notably by setting up primary dealerships and by creating these new debt management agencies. Looking at modern debt management, the model of autonomous agencies sitting outside or within the Ministry of Finance dominates. You might have heard of the National Debt Management Office in London, or the Finanzagentur in Frankfurt, or the Agence France Trésor in Paris. These agencies don't call the shots on how much money the state borrows, or indeed how this money is spent. That is the realm of usually parliamentary budgeting. But instead, they are in charge of deciding how the state borrows money. Debt managers seek to manage debt in the taxpayer's best interest. That is no small task. A government's debt portfolio is usually the largest financial portfolio in the country. Debt management in the 21st century has become more complex and also much faster. The story here is in line with financial market developments more broadly and bound up with technological innovation. The government bond market has two levels, the primary market and the secondary market. Debt managers usually put new securities up for sale in the primary market, where they're mainly bought by so-called primary dealers. Primary dealers are a select number of banks that are given privileged access to debt auctions or debt syndications in exchange for a commitment to buy and sell bonds in the secondary market. The makeup of these primary dealer groups continues to change. Big banks are key players, but you also get smaller regional banks who want to be a dealer in their country. Any subsequent trading of bonds, and this is indeed the very bulk of trading, takes place in this secondary market. Underlying debt management modernization, such as creating semi-autonomous agencies or issuing debt via auctions, is a change in thinking about debt management. Domestic public officials, as well as influential international bodies, here notably the World Bank, the IMF and UNCTAD, they began considering debt as a portfolio. So debt management became focused on so-called portfolio optimization. To achieve this, debt managers pursued a diversification strategy. First, of debt instruments, and second, of bond investors. Next, portfolio optimization was pursued with the use of financial derivatives, such as interest rate or currency swaps, to hedge domestic interest rate risk or to hedge currency risk. The everyday practice of debt management can be organized in a variety of ways. Let's look at a few examples of the many decisions that public debt managers must make. about, for instance, whether, and if so how, primary dealers are rewarded, about the kind of debt instrument that will be issued. For example, how long should the maturity be set? There are trade-offs. Short-term debt is often cheaper for the state, but more risky in the long or medium term. Decisions about whether to issue debt in another currency, and whether to cater to the demands of long-term institutional investors, like pension funds, by linking the coupon payments of bonds to an inflation index, so you're inflation-proofing investment. And then, how best to issue green bonds? That's the newcomer of government debt securities. Public debt management can pursue many strategies, and these strategies are not neutral, and they are not apolitical. They have implications for income inequality, monetary policy, fiscal policy, and financial stability.